Watch inflation, and you'll understand the market's next move. Inflation data, price pressure. Inflation shows how fast prices are rising in an economy. It is one of the most important drivers behind interest rates and market direction. High inflation equals pressure on central banks. Low inflation equals room to stimulate the economy. What is inflation? Inflation measures the change in price of goods and services over time. When inflation is high, money loses purchasing power. Cost of living rises. Central banks must react. Key inflation reports. 1. CPI, Consumer Price Index, measures prices paid by consumers. The most watched inflation report. 2. PPI, Producer Price Index, measures prices at the producer level, often signals future CPI moves. How inflation moves the market. High inflation. Central banks likely raise interest rates. Currency strengthens. Gold often weakens due to higher rates. Market volatility increases. Low inflation. Central banks may cut rates. Currency weakens. Gold tends to rise. Stocks often benefit. Markets move on expectation vs actual data. Inflation and central banks. Central banks target stable inflation. If inflation is too high, policy becomes hawkish. If inflation is too low, policy becomes dovish. Inflation data often decides the next rate move. Impact on major markets. Forex. Higher inflation, stronger currency, if rate hikes expected. Lower inflation, weaker currency. Gold, Zoust. Inflation, fear, gold bullish. High interest rates, gold bearish. Stocks. Moderate inflation, positive. High inflation pressure on stocks. Common trader mistakes. 1. Trading before CPI release. 2. Ignoring market expectations. 3. Confusing inflation news with instant direction. How smart traders use inflation data. 1. Check forecast vs actual. 2. Trade after volatility settles. 3. Align trades with monetary policy. 4. Combine inflation bias with support and resistance. Final thought. Inflation is not just a number. It is price pressure that controls interest rates.